But essentially, as it said in your program here on the website, what I have titled my lecture here today, which is a bit out of character for me, someone who not only is a member of the right, but to the extent that anybody might know who I am, I'm identified with the right. I don't usually give talks that would be all that critical of the right. I might have certain issues here and there over the years where the conventional right-wing position is not necessarily my own, but those aren't usually the things I'm most passionate about or speaking about publicly. But today, if I do this right in the second part of my speech, I do hope to have offered up a comprehensive critique of both the right-wing and left-wing narrative about the financial crisis. So I've titled the talk, What Caused the Crisis? The Left and Right Have It Wrong. And what I'm going to do here in part one is just basically explain why I think this topic's so important and try to walk through a little bit of a timeline as to what we mean by the crisis. Because it's important that I be humble enough to recognize that everybody's vantage point on this is going to be a little bit different, and particularly humble enough to recognize it'll be different from my own. I happen to, A, work in financial services, and B, handle the investments for a great deal of people who've been affected, of course, by the economy and capital markets over the years, but C, work for a very large Wall Street investment bank. And when I say work for them, I run my own private practice within them, but nevertheless have been a part of this organization since before the crisis started and have an awful lot of very good friends in Wall Street and whatnot. And so there's a perspective and kind of information embedded in this that's going to be very different from that of a lot of people. But I think all people are familiar with the term financial crisis. Most people probably associate it with the year 2008, and for good reason. But some may think of it as, of course, the recession in which we had, which admittedly was a rather deep one. There's a big political overhang to it. And whether someone believes that the crisis is what we're still in now, or it was 08, or it was 07 through 09, that's neither here nor there. I want to kind of give a backdrop to what it is we're talking about. And then the second talk's going to be a bit ambitious, because I want to actually get into, first of all, what did not cause the crisis. I want to explain what did cause it. I want to explain what they're doing to fix it that's wrong. And then I want to explain what ought to be done as I see it, and which is important to clarify. Everything I say today represents my opinions only. It certainly does not represent the opinions of my employer or anyone else in Wall Street, anyone else in Main Street, anyone else in this room, anyone in the hotel, food and beverage industry, anyone at Acton Institute, Ruth Institute, Center for Cultural Leadership, Mitchell Bonson, Sadie Bonson, Graham Bonson, Jolene Bonson, or my late grandma Bonson. Just David Bonson. That's all I'm speaking for today. This topic is so important for one reason. It will dictate a large part of economic policy in our country for the next 50 to 100 years. The relationship between the citizen and state is going to be largely determined by how our reaction to this financial crisis goes. I believe we're at a crossroads in our country regarding the relationship between the citizen and the state, and between freedom and, as Father Sirico referenced, F.A. Hayek's reference to serfdom. I think that this is symptomatic of a much larger issue. And I'm going to use the historical precedent that most drives me in my enthusiasm for this topic, and that is America post-Great Depression. No singular event had a greater influence on the way in which the government and the citizenry changed in the last 75 years than the way in which America reacted to the Great Depression. Ideas have consequences. Not all consequences are driven exclusively by ideas. People drive actions. All kinds of movements come from all kinds of different things. But that doesn't mean that ideas are irrelevant. Ideas are anything but irrelevant. And unfortunately, the ideas that came out of the Great Depression had vast consequences that we continue to deal with today. And the ideas that we come out of this financial crisis with will have the same consequences. I'll be honest, I'm an optimistic person, a confident person, If we could ever get somebody in the political persuasion I come from to run for office that has the same degree of confidence that we had when Ronald Reagan ran, we'd win in another landslide. That is the underlying issue, I think, that is missing so often. Of course, the confidence must be justifiable, but that part's easy. We have the right ideas, but we don't have necessarily always the confidence to exude them. So I'm going to apologize in advance today because some of the things I'm saying are going to sound uncharacteristically negative or pessimistic. The reality is, I suspect we've largely lost this first battle regarding what the narrative of the financial crisis of 2008 is. The winners early come from an ideological perspective that I think is utterly dangerous. The winners of who wrote the history of the Great Depression, largely then and there at the time, culminating in about 46 consecutive terms of office for Franklin Delano Roosevelt, ushered in the New Deal, which of course decades later, ushered in Lyndon Johnson's Great Society, all of which, there's no discussion of Obamacare today if there wasn't a discussion of Medicare in this 1965. There's no Medicare in 65 if it wasn't FDR and the New Deal in the 1930s. So ideas do have consequences. You know, Andrew Sandlin spoke earlier about the role that elitism played in causing the crisis. So much power put in the hands of a few men, and he referenced Robert Rubin, Alan Greenspan, and Larry Summers. The aftermath of the crisis so far has not been to lower the power given to elites. Unless this trend is reversed, we're headed to a massive concentration of power in the hands of elites, both monetary, political, regulatory, etc. So I want to talk about the timeline of the crisis, and then we'll get into those other areas I mentioned in the second talk, and I'll do my best to keep it organized. After the talk's done, not only will everything today be available for free by MP3 file and digital file, but I will turn my talk into an outline form available that I'll put on my site and make available to you. Because if you had an outline in front of you right now, it would be easier to follow my talk and easier to not pay attention. All right, off we go. So the financial crisis of 2008 started in 08, 07, 06. No, and I'm not going to say it started with the writing of the Communist Manifesto or anything like that. The financial crisis started in 1938 in a lot of ways with the passage of the New Deal. We basically had just put the nail in the coffin of the Great Depression when along came a very interesting piece of legislation passed by Franklin Delano Roosevelt as part of New Deal Acts. There was New Deal Act after New Deal Act. You study the history of this, you wouldn't even believe it. But if you think Fannie Mae is something that became a household term in 2008, 2007, there was a lot of talk amongst the Bush administration about it in 2005. There was an accounting scandal in 2002, 2003. The Clinton administration just blew Fannie Mae through the roof in the 90s. But no, 1938 represented the passage of the Federal National Mortgage Association, as we call it, Fannie Mae. We'll jump ahead in our timeline a bit to 1969, at which point Congress gave Fannie permission, instead of just buying FHA loans and VA loans. Originally, they were just there to take all these Federal Housing Administration loans and veterans loans. But in 1969, Congress empowered them to begin buying conventional mortgages. Also in 1969, I think it coincides with our timeline if you're taking notes at all, Angelo Mazzillo founded the company that became Countrywide Financial. I was able to find no answer in my research at all as to whether or not Mazzillo had the same golden tan in 1969 that he displayed throughout the 2000s, but nevertheless, point of note for the timeline. But in 1970, Congress, in their infinite wisdom, determined that it was unacceptable to have such a massive monopoly of agency buying these conventional mortgages that Fannie Mae was, and it would be helpful to have a duopoly instead of a monopoly. So they then empowered the sister, cousin, or whatever you want to call it to Fannie Mae that we call Freddie Mac. And that really solved everything. So now we had two organizations, Fannie, Freddie. 1977, the famous passage of the Community Reinvestment Act under President Carter, which did order banks to meet lending quotas in low and moderate income neighborhoods. Hold the thought on Community Reinvestment Act, because I'm going to argue later that it is very much misunderstood in its role in the crisis. And sadly, this is something the right is getting wrong, either intentionally or accidentally. Very important development, because if you live in my home, we do not talk ill of Ronald Reagan frequently. But I will say that the 1986 Tax Reform Act contained one provision that had an unintended consequence. By the way, are most bad things in government legislation intended or unintended? That is the correct answer. You all get your parking validated when we're done. But President Reagan, in his Tax Reform Act of '86, included a provision that allowed for the interest on home equity lines to be tax deductible. Of course, first mortgage interest was already deductible. Auto loans, credit card loans, consumer loans, of course, were not deductible, providing, I think, the kind of birthplace for the incentive to replace a lot of consumer debt with debt that would be tax deductible and therefore leaned to the value of property. 1989 to 91, it's amazing to me this isn't discussed more, the savings and loan crisis, kind of the predecessor event to the great financial crisis of '08, a significant period in our country's history. Certainly the event that I would argue most guaranteed the election of President Clinton, President Bush Sr. suffering from the hangover of the savings and loan economy, unable to ever garner the confidence needed to get re-election in the midst of that tough economy. 1996, very, very rarely discussed, very rarely written about, but an important event to understand. President Clinton ordering then Attorney General Janet Reno and her Justice Department to assume oversight of regional bank compliance with this vamped up Community Reinvestment Act. The Community Reinvestment Act of 1977 under President Carter, another rule in my home, by the way, never say anything good about Jimmy Carter. But the 1977 Community Reinvestment Act was really quite benign, but the amended version of it in '96, as far as systemic financial risk, the amended version in 1996, and the manner in which oversight was taken over. We already know Janet Reno, her of machine gun in child's face in Florida, was a bit, shall we say, aggressive in her tactics, and so this was an interesting development. So the subprime bubble was 2007, 2008, correct? Who believes that? The big subprime bubble. We had never before seen home mortgages given to people at 18% interest that were bad borrowers. And in '08, all of a sudden, it hit a crescendo. Well, no one's raising their hand because you're apparently all very smart. It's patently false. A major subprime bubble took place, ending, let's call it, in 1998. A high percentage of subprime borrowers did lose homes. The largest subprime banks in lending institutions in the whole country went fully out of business. Who do you believe today even knows about this, let alone experience systemic risk from it? It's not even a known commodity, let alone was it an impactful one across the system. So we're going to discuss how that could be. How is it that in 1998 an event took place that had almost no hangover, and in 2008 the supposed subprime crisis brought the world to its knees. 1999, Andrew mentioned the Time magazine cover with this alleged holy trinity of modern finance. Larry Summers, the chief of economic affairs of the Clinton administration, head of his council of economic advisors. Robert Rubin was his treasury secretary, former president of Goldman Sachs. And the third member, of course, the maestro himself, Alan Greenspan, who served as chairman of the Federal Reserve for over 475 years. I'm going to talk about Greenspan a lot more later because none of my children are in the room. 1999, an important event, but not for the reasons we say, so I just want to throw it out there. The repeal of the Glass-Steagall Act. Glass-Steagall was passed as one of these other New Deal pieces of legislation, largely credited Glass-Steagall with helping get us out of the Depression and resume investor confidence, because no longer could these big, huge Wall Street banks take depositor funds and put them in risky investments. But then they repealed it in 1999 in a bill quarterbacked by Phil Gramm called the Gramm-Leach-Biley Act, which enabled these large investment banks to all of a sudden do all kinds of real bad things. So it's an important date in time because it certainly was cornerstone legislation, but I'm going to be arguing later on what I think about the idea that Glass-Steagall and the repeal of Glass-Steagall played a role in the crisis. By the way, just for curiosity, the company I work for is an investment bank on Wall Street called Morgan Stanley, and J.P. Morgan is the largest commercial bank in the country, And in the 1930s, Morgan Stanley was born because of Glass-Steagall. A few investment bankers that had to leave J.P. Morgan went. So you had that kind of separation going on in the capital markets. But anyways, that was repealed in 99. It, by the way, wasn't, at that point, it was really almost symbolic. Financial institutions had been functioning as supermarkets for quite a long time. In 2000, in 2000, I think that the singular pivotal moment of the 2008 financial crisis took place. Now, I'm going to explain this better in the second part of the talk, but I want to dangle this carrot a little bit. That is the crash of .com. There would not have been a 2008 financial crisis had there not been a 2000 .com. And I'm going to make a case later that hair of the dog economics has been driving our country for a long time and is unfortunately now driving it again. But ultimately a good portion of the housing crisis coming about as a result of policy decisions made post.com. Certainly a brutal period, though, in the capital markets. 2000 to 2001, by the way, the Federal Reserve lowered interest rates 11 times. At one point, the short-term rate was at 6.5%. They brought it all the way down to 1.75%. The last cuts there were, Greenspan said, were a result of 9/11 and fears of what 9/11 would do to the economy. It was necessary to lower rates again. And then in 2003, he doubled down on those low rates, bringing even the 1.75 all the way down to 1%. Hold that thought. 2003 to 2007, the amount of subprime lending, and by subprime, I'm referring to real subprime. The vast majority of the housing market dealt with what we call Alt-A, which is different than subprime for technical purposes. But now, I don't know if it's a big deal or not, but the term that is always used to describe all of the above is subprime, but there ought to be a distinction. I'm using subprime right now to connotate pure subprime, where they were really, really, really bad borrowers and still got loans, usually at high rates. Very insignificant portion of the overall collapse, but it tripled over a 4-year period, reaching a level of $1.3 trillion in the American economy, which pales in comparison to the amount of the other kind of subprime that was going on, which was probably very good borrowers, but taking very bad loans. And unfortunately, that nuance gets missed a lot. February of 2007, a full 18 months before what we think of as the peak of the financial crisis, February of 2007 is when the subprime lenders began dropping like flies. Here in Orange County, let's see, we're at Southwest Plaza, right? So if you were to go south on the 405 freeway, just one exit, and look to your right, you see a whole lot of buildings that are not occupied by mortgage lenders anymore, and they almost all were, just literally 5 years ago. I'm sure a lot of you live here in Orange County. But the epicenter of that mortgage world began falling in early 2007, and Orange County playing a big role in that. August of 2007, not insignificantly, an awful lot of quantitative hedge funds, very sophisticated computerized models of trading, mostly real successfully, began utterly blowing up, models being decimated, largely without explanation to the masters of the universe that had created them. In October of 2007, big, huge Wall Street firms began taking big, huge write-downs on their own balance sheets. Merrill Lynch fired their CEO, Stanley O'Neill. Citigroup and Morgan Stanley, all the big ones, with a couple exceptions, began taking huge write-downs on the balance sheet, and stock market drop began. And we're still a full year away now from the kind of capital incidents. March of 2008 is a very important event because the timeline between March of 2008 and September of 2008 is so long, and yet a lot of people associate it all together. And I'm going to argue that actually the period of time that went by in between March of 2008 and September of 2008 represents one of the huge failures of the Bush administration. Bear Stearns collapsed in March of 2008 from a high of roughly $170 a share, went to bed on a Thursday night, and it was somewhere in the 60s. Woke up Friday morning, it was somewhere in the 20s. And then on Sunday night, it was sold for $2 per share, ultimately getting done at $10 per share because of a really fascinating legal mess-up that required them to get the deal done at 10. So J.P. Morgan bought Bear Stearns in March of 2008 for $10 per share. $1 billion of risk was assumed by J.P. Morgan, which was slightly less than the market value of 383 Madison Avenue, where they are at, that building that they owned, and $39 billion of risk after the first billion was assumed by the Federal Reserve. Not the Treasury Department, but the Federal Reserve. So March of 2008, now you have Bear go, but Bear didn't declare bankruptcy, and Bear was assumed into private hands. For an entire week with no deal done whatsoever, J.P. Morgan assumed the monumental responsibility for clearing all their trades. The counterparty risk all over the world was monumental. And in this time period, the Fed kind of created the backstop, and Bear was saved. So we're going to have a conversation as to what happened between the Bear incident. People can like what happened with Bear, not like what happened with Bear. I had a lot of extremely good friends that worked at the firm and was fortunate enough to have met some very high-ranking people in the firm in the city many times. And all I can tell you is it's a tragedy, a human tragedy, what happened with Bear Stearns. But the far bigger tragedy is that not one single lesson was learned from it, with 5 full months to do it. So we need to have a conversation about that. Then we're going to fast forward a little bit after Bear's fall in March of 2008 to July of 2008. I don't know, for those of you who aren't here in Southern California, if IndyMac was the same brand presence around the country that it was here in the Southland. But IndyMac, a large retail bank chain here, was taken over by the FDIC. So a huge bank failure from a real kind of aggressive mortgage lending commercial bank. And then Secretary Paulson received permission from Congress to achieve much greater intervention with the GSEs, government-sponsored enterprises, and it's code for absolutely nothing but Fannie Mae and Freddie Mac. There is another one, but they're not important in this, the Federal Home Farm Bank deal. Okay, so at that time, Paulson uttered his very famous line, "If I have a bazooka in my pocket, I won't need to use it," which is, I don't know, kind of interesting, I suppose, in theory. You can't really fit a bazooka in your pocket. But it didn't turn out to be one of the more prescient calls that was made. But he did receive that congressional authority, though, in July of 2008. And then on September 7th, 2008, as my wife and I are driving back from our anniversary trip up in Santa Monica, I turn on the radio bright and early to hear that Fannie and Freddie have been put into conservatorship, where they sit to this day, and everybody in this room is now a shareholder. Congratulations. At the time, we were into them for about maybe $200 billion. It's now since then gotten up to about $430 billion and still climbing. Not a single calendar quarter has gone by since that time in which the amount Fannie and Freddie are into us has not increased. Then 1 week later, so the entire week of September 8th to September 15th was spent market dropping, panic, a lot of weird things going on, but we had not even come close to how bad it was about to get. At which time, every day the focus was on what was going to happen to Lehman Brothers. They were the next firm that apparently was going to go. They had the most leverage, most toxic assets, made the worst decisions. This was kind of the narrative. The short sellers, those betting against the company, were out in full force. And so after Bear now, and we see everything going on, Lehman was next. So that week was spent with a lot of rumor and a lot of genuine discussion as to how Lehman would be able to be saved. And ultimately on this weekend, that books have been written about. I've now read 44 books on the financial crisis, and my goal was to read every single book that comes out, because I thought that maybe 10 would come out. And now I'm in a cap at 60, so I have 16 to go, and then I'm done. I'm sick of it already. But of the 44, if you want to read a book that is just sort of like literally a mystery thriller, soap opera type about that weekend of Lehman going down, I would suggest Andrew Ross Sorkin's Too Big to Fail, who's a host on CNBC every morning from 3 a.m. to 6 a.m. Pacific time, and really a very gifted writer. He doesn't know a whole lot about anything, but he's a good writer. But anyways, that weekend essentially And Hank Paulson, by the way, former Secretary of Treasury Hank Paulson, wrote a book himself, a tell-all book about this whole weekend. So there's a lot of pretty undisputed set of facts out there about what took place. But essentially, the Treasury Department drew a line in the sand that they were not going to take over Lehman. There wouldn't be federal assistance available to the company, but they were going to do everything they could to facilitate some sort of an arrangement that wouldn't require Lehman Brothers to fall. Now, Lehman was not even close to the size of a Goldman Sachs, Morgan Stanley, Merrill Lynch, Citigroup, Bank of America, but they were a big, big deal. But what was particularly burdensome about the Lehman case is the amount of leverage on was just absolutely extraordinary. So therefore, there was a lot of counterparty risk. I think this is a notion that is really missed a lot of the time in understanding these things, that look, I'm not making an argument for or against any bailout whatsoever. I'll tell you anything you want to know what I think of all this stuff. But just so we understand, it isn't quite intelligent enough it's not worthy of those of us in the room that care about these things to simply point out that we want all these losers to fail. That may be true, and we may want their counterparties to fail and the counterparties to their counterparties to fail. You can be for it or against it, and I'll tell you what I think. But I just want us to at least understand what we're saying. They weren't concerned about one of these firms. They were concerned about the counterparties of the firms. And that's either legitimate or it isn't. But I just want to make that clear, that the counterparty exposure of Lehman Brothers petrified the administration, particularly the Fed and, of course, Treasury. In case anyone cares, basically Bank of America was their last hope to buy Lehman. They really weren't ever very serious about it. Barclays in England, the largest bank in Britain, was very serious. At the final minute, it was not able to get done because of some events and some of the red tape required in the British banking system. When Barclays was done, Lehman was done. They announced they'd have to declare bankruptcy on a Sunday evening. The entire day that this is going on, September 15th, 2008, secretly, behind the scenes, Bank of America was negotiating the deal with Merrill Lynch to buy them. Merrill Lynch saw the writing on the wall. They'd be next. So at the time Lehman announces bankruptcy, and the very next day they announced that Merrill's been acquired by Bank of America. Bank of America earlier had also acquired Countrywide. And so you have this large organization, but Merrill Lynch, a darling of Wall Street, one of the only institutions left not owned by a big, huge bank selling to a big bank. Probably for those of us in the financial world who care so much about capital markets, and remember this, regardless of political inclination, nobody cares about capitalism thoughtfully if they don't care about the capital markets. There is no capitalism without capital markets. And ultimately, it was, I think, one of the darkest days in U.S. history, Lehman going down and essentially Merrill going down along with it. At this point now, Paulson and Bernanke, you have to think, are grateful that they didn't live in Prohibition. Although I think, if I was speaking about teetotalers earlier, I think, from what I understand, Paulson's actually a teetotaler himself just by his own decision. But either way, this probably wouldn't have had a lot of time for happy hour anyways. An extraordinary 24 hours. Then the large insurer, AIG, went down one day later, and essentially at this point, the line in the sand about no government money, that sand was kicked over very quickly, and we're about to go through an avalanche of government money. But they cried uncle. They had their line in the sand on Lehman. Lehman went down, and then all, pardon the expression, all bloody hell broke loose. AIG received an $85 billion loan from the federal government, originally at 8% interest. It's always interesting to me to think that this would pacify people. A lot of people are going to be real upset they're lending money to a company to begin with, which would be a pretty legitimate thing to be upset about. And other people will say, how do you expect any entity that needs $85 billion to pay 8%? So it was sort of like they couldn't have possibly messed that thing up worse than they did. And then within one day from there, two Wall Street investment giants, Morgan Stanley and Goldman Sachs, appeared to be next. Stock prices collapsing, the shorts at this point in utter full-blown war on what remained of Wall Street. And then on Thursday, September 19th, and now we're talking about 3 straight days where I can't even imagine how little the folks in D.C. and New York had slept. Certainly a lot of people around the country hadn't. I know I had not. A very painful week in my career and life. But the Thursday, the Fed announced loose plans for what became acronymed as TARP, later. There were no details announced whatsoever. It was just leaked to Steve Leisman of CNBC that there was going to be some form of a congressionally driven bailout of sorts. Brought a little bit of relief to the market, and then here we go. So I'm going to try to go through this quickly and let you all take a break. September 25th, Washington Mutual was then taken over by the FDIC. It was also sold to J.P. Morgan, the same firm that acquired Bear Stearns back in March. And on Monday, September 29th, as I sat at Morel's Wine Bar and Cafe right in front of 30 Rock in New York City with my dear friend Brian Harrington, who's hopefully listening right now online, we listened to the Dow drop 777 points, the worst point drop in the history of the Dow. Not, by the way, the worst percentage drop ever, which was on Black Monday in October 1987. But nevertheless, a nearly 1,000-point drop in the Dow. My friend Andrew Sandlin texting me every few minutes to see how much wine I was drinking. I'm now a teetotaler myself, but at that day I was not. And unfortunately, the Congress had, fortunately or unfortunately, you can think whatever you want, Congress voted down TARP that day. So the market dropped like crazy, and then things kind of got worked out, twisted, turned. I think a number of people voted against it, seeing the market's reaction, got scared into then voting for it. It was brought back before the House. October 3rd, President Bush signed TARP into law, the Troubled Asset Relief Program, and then everything should be better. TARP failed. Market dropped almost 1,000 points. Then TARP passes. And from October 6th to October 10th, we did suffer literally the worst week in the history of the market, percentage-wise, not just point-wise. The 5 days after TARP passed were worse than the day in which TARP failed. The market dropped 22% in 1 week, which was as much as it dropped on all of Black Monday in one day. But if you remember, the day after Black Monday, the market made back about half of its loss. So in reality, this week, October 6th to 10th, became just an absolutely painful week for investors, but much more important to those of us who happen to work in the business of investing stocks and bonds and things. Worse for forget hedge fund managers and all of us in the business. For regular people around the country, the reality is that these things, of course, were trickling down. Consumers were not spending. The markets had totally dried up. And what was driving a good portion of this is $140 billion had been withdrawn from money market funds in 1 day in September. And the commercial paper market, which corporations borrow money overnight, highly AAA companies, completely, totally dried up. Paulson alludes to in his book that General Electric calling them and saying, and this is one of the biggest, healthiest balance sheets. At the time, they had one of the only AAA credit ratings in the world for a corporation. Them saying, we can't tap the commercial paper market. There was no money flowing. So then, worst week in the markets, October 6th to 10th, and October 14th was the day of the famous meeting where the 9 largest financial firms were forced to Washington, D.C. for a meeting with Chairman Bernanke of the Federal Reserve and Secretary Paulson, and told that they would be taking what amounted to a total of $250 million as part of the $700 million that TARP approved, and that they would be taking this in the form of the government assuming an equity position in their company. Now, because the mic is rolling and so forth, I'm being serious right now. There's some things I just cannot say about it. But I'm going to tell you what I really do think. But as far as some of the specifics to it, maybe we could talk during the Q&A or something, or what have you. I believe that this particular day, it was largely a charade. I have an awful lot of reason I believe this, for 2 of those 9 institutions that were literally going to collapse without it, that were gigantic, global, and the counterparty interdependence issues, Middle Eastern financial partners and especially Chinese financial partners were absolutely not going to be able to tolerate these entities going down. And so, but rather than just single out those 2, it became necessary to spread this bailout amongst the 9. It's important to note, by the way, that all 9 of those institutions have now paid back the government in full. And I don't mean that in the way this little General Motors idiot does, where he goes on TV and lies and says they paid back the government when they still owe the government $46 billion. But he's simply referring to the fact that they borrowed money from the government to pay back the money that they took from the government, so they'd be eligible to then borrow new money from the government. Okay, I'm referring to the fact that total net from day one to final closing of the balance sheet, these 9 firms have all paid back. I'm going to name 3 entities that have not. Fannie, Freddie, General Motors. Okay, and we move on. Then, of course, in November, everybody knows President Obama was elected. January and February of 2009, you thought that the September and October period I described was bad enough. January of 2009 was the worst January in the history of the stock market. February of 2009 was the worst February in the history of the stock market. And then on March 6th, for those that have eschatological interest in the room, the S&P hit what I believe is its generational bottom, 666. From which point the market has since more than doubled in its recovery. And you can tell me if this is just a post-hoc ergo propter hoc fallacy or not. At the same time that the market hit its bottom and has since begun this recovery, Congress suspended FASB 157, which was the mark-to-market accounting rule that was requiring all these financial institutions to mark down the value of these assets, which remarkably were not finding a lot of buyers at the time. My good friend Brian Wesbury, economist at First Trust, a man of faith and conviction and a brilliant economist as well, Wheaton grad, by the way, Wheaton professor at one point, has said it's akin to a house in the neighborhood is on fire, and then you got to find a buyer for the house on fire, and whatever that price is, that's what everybody in the neighborhood has to then go mark their house out. It was probably well-intentioned, to be quite honest, legislation, but very, very ill-conceived, as we're going to discuss. So then now here we are today. We realize the unemployment rate did hit a peak of 10%, but the stated unemployment rate now still well above 8%. The underemployment rate closer to 20%. The banks by no means in a healthy position, but at least the large majority of them that are going to survive have survived. Congress passed the massive Dodd-Frank legislation, the new Financial Regulation Act, which I'll talk about in my next talk. Federal Reserve lowered interest rates to 0% at the bottom of 2008, and here we are today in April 2012, and they are still at 0%. So much for temporary stopgaps. That's what I'm going to start doing whenever I just say, you know what, I'm really, really hungry. I'm just going to cheat on the diet for this one thing and then let it go 4.5 years. But with that timeline in play, let's go ahead and take a quick break. We'll let the wait staff here at the hotel clear things that need to, and then we'll come back to get into part 2 of my talk, okay?